We have with us today the Deputy Superintendent for Property and Capital Markets of the New York Insurance Department, Michael Moriarty.
Good morning, Frank.
Mike, how are you this morning? Good.
I'm doing well, thanks.
Good. We should note for the record that I personally and CATEX have known Mike now for 15 years, and we can truthfully say that the citizens of New York are well served by having such a conscientious public servant as Mike working for them, so we're very happy to have him today. Mike, your superintendent recently made some news, Mr. Dinello, with his announcement about the proposed change for the reinsurer collateral requirements for alien reinsurers. Before we get into specifically discussing that, if you could perhaps just give a very, very brief overview of the current requirements for alien and I suppose any non-New York domiciled reinsurance company as far as what they do have to collateralize before they're permitted to write business in New York.
Sure, Frank. Under the current rules, which have been in effect for decades, it's basically a binary system. If you are a licensed or an accredited reinsurer in New York, which means you apply to the department and the department does its due diligence on the financials and the ownership and management of the company, then any New York company that cedes business to that reinsurer will get full credit on its financial statement. And what that does is, if you cede business to a licensed or an accredited reinsurer, you can effectively reduce your loss reserves with the anticipation that you will collect from the reinsurer. If you are not a licensed or accredited reinsurer in New York, then in order for the ceding company to take credit on its balance sheet, it has to get collateral from the unlicensed reinsurer for the full amount of the reserves that have been transferred to that reinsurer. This basically was enacted on the basis that we do not have control of the unlicensed reinsurer, and therefore, in order to get credit, the ceding company would have to require collateral from these unlicensed reinsurers, whether they're in the United States or abroad.
So they could theoretically be, for example, in Connecticut, which has no puny regulatory reputation itself.
That's correct, Frank.
Okay. And the commissioner noted, the superintendent noted in one of the interviews I saw, that some $120 billion is collateralized in the United States from foreign reinsurers. How much of that do you know offhand is in New York?
Frank, I do not know. I would anticipate that a significant amount have been ceded by New York State licensed companies, whether they're domiciled in New York or licensed in domiciled in another state and licensed here. But clearly that figure indicates that reinsurance is truly a global business. There are many significant reinsurers with a significant amount of capital, both in Europe and in Bermuda, that serve the insurance industry well in dispersing some of the high layer risks to these reinsurers around the world. So it's truly become a global business, and I think that's one of the reasons that the superintendent felt the need to modernize the current requirements for credit for reinsurance.
Well, one thing, Mike, that we did notice, and we don't necessarily need to get into the specific details of Mr. Dinello's proposal, but one of the things we noticed is that for the non-New York reinsurers, there's a sliding scale suggestion, and I say suggestion because I'll come back to my reason for that word in a minute, that's in place based on credit ratings received from at least 2 credit agencies. And then there's a catch-all at the bottom, which as an attorney I understood the import of that immediately, and certainly as a regulator you understand that, which is why it's in there, is that the ceding company reserves the right at all times to negotiate any degree of collateralization the ceding company wishes. So if anybody is upset with the sliding scale or has some concern about the worthiness of the credit rating, they're free to go ahead and demand whatever collateralization they feel they require. Is that pretty much correct?
That is correct, Frank. And what we are trying to do here, and part of the the impact of this regulation is to shift responsibility for credit risk management and compliance to the seeding companies. Under the current system, either you're licensed or you get full collateral. Basically, what the regulation does, it manages the credit risk for the seeding companies by requiring under the statute full collateralization. But this basically recognizes that this is the responsibility of the seeding company. The regulation does require that all seeding companies, whether you're seeding business to licensed companies or unlicensed companies, that it's a responsibility of the seeding company to take certain steps to manage its credit risk. When I say manage its credit risk, I mean do its due diligence in terms of looking into the financial condition of the company that it's seeding business to, monitoring the results of the reinsurance contract, making sure they're getting paid on time, et cetera, et cetera. This is a responsibility of the seeding company, and that's what we try and do. By establishing the sliding scale, we try to recognize that there's varying degrees of risk when you seed business to a reinsurer. It's like any other counterparty. Obviously, if it's a AAA reinsurer, we try to recognize that the risk of not being paid is relatively small, whereas if you're a BBB company, there is some risk in getting your reinsurance recoverable. So that's what the proposed regulation tries to do.
Let me, I guess I'd be remiss, and I'm sure you've been asked this question, or certainly the superintendent has, but given, for example, the recent turmoil in the markets with the subprime debacle going on, just how valid do you think putting faith in credit ratings from Moody's and Standard & Poor's and other people might actually be?
I think that's a valid question, and clearly we do not want to defer our regulatory responsibilities to the rating agencies. But the rating agencies, I mean, they have taken a hit in the recent subprime debacle. But the rating agencies, they do a fairly adequate job on the assessment of straight corporate risk. The subprime were these complicated structures that arguably the rating agencies may have missed some of the nuances of these, but the rating agencies' ratings are recognized throughout the capital markets, and to a certain extent they may have been demonized in this recent subprime issue. When there were a lot of people that were at fault, whether they were the lenders, the investment banks that put these together, the brokers, and the borrowers themselves.
Yes, so, let's not forget them.
And we are cautious, and that is why the proposal does require that one of the requirements is that the assuming company have $250 million in capital in addition to the rating. We believe that reinsurance, to be a global reinsurance, you need a significant amount of capital, and basically, if you don't have more than $250 million, you really shouldn't be in the reinsurance space. And again, we do require due diligence on the part of the seeding companies. We do require notification to the department if the seeding insurer is not well diversified or has a significant amount of reinsurance recoverable from one reinsurance carrier. And finally, we do require the reinsurer, if the seeding company is put into liquidation by New York, the assuming reinsurer at that point must fully collateralize its obligation to the seeding company. Therefore, if there is a concern about attaching assets abroad, once the seeding company, in those rare cases where the seeding company is put into liquidation, the assuming company will post that full collateral.
Let me ask a couple of questions as far as industry reaction goes. I see that our mutual friend Frank Nutter at the RAA released a statement yesterday saying that he's coming back to you folks with a letter by the end of the week giving his group's opinions of the change, proposed change. And there's some commentary by some industry people. Actually, I'll be able to cite the name. Bob Hartwig at the III said that Mr. Dinello is trying to increase the flow of capital into the New York market. However, the opposition to the ending collateral requirements is couched in terms of being fiscally conservative, and the other side says that it's a protectionist measure kind of thing. There's two strands here, and if you'd bear with me, maybe you could help me figure this out. If, for example, a major New York primary went with a Cayman Islands-based reinsurance company that was AAA rated and was not required to post collateralization, and then somehow the underwriting at the primary company was all askew in many different areas, and they began to run into difficulties in meeting claims payments, and the eventuality that perhaps they had reinsured against in fact then occurred, and for some reason or another the Cayman Islands entity did not or was unable to pay, then that company on the primary level would presumably look to the New York equivalent of PLIGA, the Property Liability Guarantee Association, would it not?
Well, if the ceding company ran into difficulty and was put into a liquidation, there would be a guarantee fund protection for the New York risk that the primary companies were not able to effectively pay, and clearly that's a risk. I mean, when you have 100% collateral, you're virtually eliminating the credit risk. But in today's global market, you can't regulate to the worst case scenario and go under this blanket assumption that because you're not licensed in New York, you're a severe credit risk. I don't think that takes into account the actuality of what has happened, and 100% collateral from it really can't be justified from a risk perspective. It's not quantitative at all. And again, it plays to the worst case scenario, and while certainly we are taking on some regulatory risk per se, we do think that that's fully manageable in terms of who our companies cede their business to. And in the example you said, there are very few AAA companies that fall off a cliff. In other words, certainly there are reinsurers that have gotten into trouble, but generally speaking, it's it's a slow burn, and there are ways that the ceding company can effectively protect itself in terms of there will be defaults from some reinsurers, but if you're well diversified, if you are doing your homework in terms of management, we think it's something that the ceding companies can manage quite effectively. Should be managing.
Yes, yeah. Well, it certainly is going to be. I don't say this to be pejorative. It may be a new role for them to assume. That's for sure. But let's not necessarily go there. I don't ask you to comment on that. It would. Have you given any thought, perhaps, to whitelisting certain regulatory jurisdictions? I see there was something in the deep in the body of the the superintendent's press release that mentioned some equivalency of particular jurisdictions, but I'm wondering how far you've gone in that thought-wise.
Well, what we've done, Frank, is in the proposal there is a requirement that we sign, the New York Insurance Department signs what is known as a memorandum of understanding with the domiciliary regulator of these non-U.S. reinsurers. And implicit in that, and actually explicit in the provision of the reg, is a consideration by the superintendent of the regulatory environment in the domiciliary jurisdiction. And I think what we want to recognize is that there are many good regulators out there. The British Financial Services Authority, for example, it is almost a model that many regulators look to in terms of being a modern regulator, and the same with Germany, with Sweden, with Bermuda, who has taken significant steps to enhance its regulatory reputation. And again, I think this is a recognition by the New York Department that it's a global financial services business, and we have to leverage off good work that's being done by good jurisdictions, as we hope that they will leverage off the work that the U.S. regulators are doing.
Well, Mike, certainly the states are handling this as they typically do in their own different ways, which was one of, for example, Frank Nutter's, I guess, points in the announcement he came out with yesterday, is that he'd prefer, rather than a state-by-state solution, some sort of national approach to this. I guess overlooking the past 70 years of history, but perhaps
clearly, we would prefer that too, and we will work with the NAIC, who has a reinsurance task force that is looking at this issue, and they do have a proposal on the table that, in some ways, it is consistent with the New York proposal, and perhaps we can work to narrow any differences. Furthermore, we agree with Frank Nutter that the Reinsurance Association of America. We think that the model for U.S. reinsurers should be streamlined, and we would look to kind of a port of entry model whereby a U.S. reinsurer could basically be primarily regulated by one state and do business throughout the U.S. on a much more streamlined basis. So, I think we concur with some of the comments that we've heard before from the Reinsurance Association of America. Look forward to working with them, again, to put everybody on a level playing field and to allow the reinsurance market, which is a business-to-business market, to operate more efficiently throughout the world.
One final question on this, and I'm sure this came up in the deliberations. Is this proposal limited to only offshore reinsurers, or is it going to be also encompassing offshore capital market vehicles, such as sidecars and other entities that certainly could obtain very satisfactory ratings from any ratings agency, and then perhaps step into the shoes via a captive or a fronting mechanism and begin to write business, for example, in Long Island?
Well, currently it is limited to the reinsurance market, but New York has always been supportive of capital markets alternatives to disperse insurance risks throughout the capital markets, and we are actually contemplating the emergence of what is known as the New York Insurance Exchange, to perhaps serve as a model to get more capital markets activity in the insurance space, so to speak. Again, we feel that that there's a lot of capital out there that's looking for a place to invest, and there's hedge fund money, there's private equity money. The insurance risk is not correlated to other investment risks, such as the stock market or the interest rates or foreign exchanges, and we believe that the insurance marketplace could attract capital rather quickly through a model like the insurance exchange. So again, that's something that we're very supportive of.
Well, Mike, you took my last question. I was going to comment on the superintendent's August remarks about the revitalization of the New York Insurance Exchange, because that's clearly something we're very interested in.
It's something we're excited about too, and we will be working hard to gauge interest in that. It's a statute that's still on the books, so there's no legislative need to do anything in terms of the insurance law. So again, we're looking at this as an opportunity, and again, if the interest is there, both on the capital market side and on the producer side, we'll work with them to bring it back to life, so to speak.
Good. Well, Michael, thank you. Thank you very much for your time today. We appreciate it. We know you're busy up there, and we hopefully can speak to you again. We're probably going to solicit some other viewpoints on this issue. And if we can get some time with you in the future to make some comments, we'd like to do that if we could.
That'll be fine. I appreciate being on the road.
Our pleasure. Maybe we'll come up and meet you on Metropolitan Avenue one Friday night for pizza.
Very good.
All right. Thanks, Mike. Bye-bye.
Yes, bye.